Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion today, we want to say thanks for questions coming from our audience at SmithWeekly, including Mark R., Ken S., Brian H., Sean M., Levi V., and Cindy W. Back on the program today, we have a returning guest and one that we're pleased to have back joining us today. Mr. Grant Issac is on for this episode. Grant is the President and Chief Operating Officer of Cameco Corporation, the largest publicly traded nuclear fuel services provider that covers the nuclear fuel cycle, from mining of uranium through to fuel fabrication, including specific reactor services via its 49% interest in Westinghouse. Through its proven Tier 1 assets and Westinghouse, Cameco has the reputation of being the preferred supplier and service provider for nuclear utilities globally. The company is listed on the New York Stock Exchange under the symbol CCJ and also on the Toronto Stock Exchange under the symbol CCO. Grant, good to have you back to update. Welcome.
Yeah, thank you. It is a pleasure to be here again. Always appreciate your time and your interest in our story.
Yeah, Grant, good to have you back on, and got a few topics to cover off today, and certainly a pleasure to have you back on the program. And we tend to try to enjoy this maybe on an annual occurrence. So thank you for coming back on our invite. We really appreciate that. Well, we've got a lot of things to cover here, so why don't we get right into it? The company recently announced 3Q 2025 results. Walk us through some of those key areas that you'd like to bring to our attention for the audience, as well as remind the audience of where we are on 2025 year guidance.
Yeah, a good place to start. Maybe at 30,000 feet, I would just, and I don't mean to make this an immodest comment, but we just continue to do what we say we're going to do. We continue to deliver on our plan to be the most reliable, most disciplined supplier in the fuel cycle, and obviously continue to advance nuclear new build through our partnership with Brookfield in the ownership of Westinghouse. So Q3 was no different, right on plan, such that we did not meaningfully change our outlook guidance for the year that was already out there. So continue to say what we're going to do and then do it. And I think it's that commitment to delivering on what we say we're going to do that is being rewarded by investors who know that they can trust us. And when we tell them what we're going to achieve, we achieve it. And Q3 was no different.
I appreciate you covering that off there, and certainly folks can refer over to the earnings call and presentation for further information there on that front. Talk a little bit about 2026 here, Grant, as far as, are you seeing a better year ahead, if that's the right way to say it, than 2025, more of the same, maybe focus areas for improvement within the Cameco divisions during 2026? Any preview you could give us there?
Yeah, there's a lot to unpack with that question. Let's just start, and I know we'll spend a bit more time going into the market specifically, but folks have heard me say for some time now that I have actually never seen a stronger fundamental setup for the nuclear fuel cycle than I'm seeing right now. The evidence is already pretty clear in downstream fuel cycle activities like fabrication, like enrichment, like conversion. Of course, most people realize conversion is at historic pricing. We've never seen the conversion price this high before across the Western fuel buying community. And that's all really good news. It hasn't fully translated into uranium yet, and we can spend some time talking about that. But fundamentally, it has never been better, and it just seems to be getting stronger. And I would really just root that comment in the kind of work put out recently, for example, by the World Nuclear Association. They put out fuel market report every 2 years. And that fuel market report shows that the demand is up. No surprise, reactors around the planet that were shut down are being brought back. Reactors that we thought we were going to shut down early are now not only going to run, they're pursuing life extensions. Reactors that have been running are going through uprates and super uprates to add another 20 years of life to them. And then on top of that, over 60 reactors currently under construction. Recent announcement like we had in the United States, $80 billion project to kickstart AP1000 new builds in the US, plus a building order book elsewhere. No surprise, demand is up. We actually believe that the demand number that you see from groups like the WNA's fuel market report is actually understated, and that there's more demand that's going to come to this market than what is being captured in that demand outlook, because it really only captures demand from the known reactor base. It doesn't really include a revolution in SMRs or advanced nuclear reactors if it happens. It certainly doesn't include a very significant increase in nuclear demand from hyperscalers. We often trade with that group, but we shouldn't in some ways, because that fundamental story hasn't baked in that extra demand from hyperscalers. So we think the demand story tends to be understated, and that there's a lot more demand that can be factored in and probably will be factored in, including things like inventory build that's going to go along with a better demand story. Then when we look at the supply side, if I think about the uranium space in particular, we tend to look at the supply stack and we say, well, actually it's dramatically overstated, because folks are counting supply sources that will not be online in the time frame that is being proposed. I mean, just because somebody said it in a definitive feasibility study does not mean it will be so. And we think the risks to the supply side are quite significant, which to us tells us that gap is bigger. And because of that fundamental story, we remain very disciplined in making sure that we're letting that demand form and come to the market rather than trying to front run it, because nobody has ever rewarded an investor in the nuclear fuel cycle by front running demand with supply that didn't have a home. So we just think the fundamentals look good. We think 2026 is going to be a year where we see continued strong demand and perhaps even higher demand than we've seen in 2025 in the uranium segment, all reflecting that need to begin to cover the run rate requirements for that durable demand build out that's occurring. So we remain very optimistic.
Absolutely. I think there's an interesting time frame to consider here. And going back to the early days of the bear market back, 2015-ish, roughly over 10 years, it's certainly been an interesting ride, and the setup continues to work quite well here. Of course, we know that the broad market may have other things to say over this duration, which is long, but no doubt the market looks quite good in the nuclear fuel cycle. So I appreciate the comments on that, Grant. I want to get into some other stuff here in a moment, but before we do, just talking a little bit on results, a little bit of cap structure, balance sheet, et cetera, here for just a moment. Just update the audience where we stand at the company as far as cash on hand, debt, revolvers, and then also just remind investors out there who are listening in within the audience about shares outstanding at Cameco, as well as the key investors on the roster that you want to mention.
One of the things that's very different from this moment, if I compare it to previous up cycles in the nuclear fuel cycle, we've seen stronger prices for uranium. A lot of people reference that $136 per pound back in the 06-07 window, which in today's dollars is $200 a pound. And they will point out that we're not there yet. And that is one of the things that's driving our strategic patience. But if you think about Cameco's position, we're in a much different stance than we were back then. When we were in that 06-07 run up, we did capture some incredibly strong contracts as demand came to the market, demand in this case driven by a supply event. That supply event, of course, was the flooding of the Cigar Lake mine. But as Cameco, we were in the midst of a very significant expansion. We were building the Cigar Lake mine. We were building the Cigar Lake mine to replace the material that was coming out of Russia under the megatons to megawatts project. So yes, there was a demand upcycle and very strong pricing was discovered, but we had a major greenfield project that we had to deliver on. This time, we don't have any greenfield plans, Andrew. That needs to be really well understood. We have been so disciplined that we still have 30% of our already licensed, already permitted, already built productive capacity still in care and maintenance, waiting for what we know will be a stronger demand, and that stronger demand will discover higher prices. So there's a period of time for us where we can enjoy extraordinary best-in-class brownfield leverage, not requiring greenfield investments at a time when the inflation monster hasn't been wrestled down, supply chain challenges remain, where there are labor challenges, both skilled labor and skilled contractors. We have de-risked our investors from that need to build greenfield in order to catch this wave. For us, it's simply about leveraging the brownfield assets, getting our tier one assets running at full capacity when the demand has come to the market and we've captured it at appropriate prices. You know, the leverage that comes from restarting tier two already licensed, already built assets, like in Saskatchewan, like in the United States. And then, of course, when more growth is required, it's the ability to leverage brownfield infrastructure. You know, maybe a new mining asset, but running through an existing mill so that you're not greenfield mine and mill. And the reason I wanted to provide that context is it just means that as this market recovers, as prices strengthen, and as we capture those prices in our committed sales portfolio, our cash flow generation has never been stronger. Then you add to that the fact that we are the owner of half of Westinghouse, and Westinghouse's core business is benefiting from the exact same tailwinds that are blowing in the uranium, the conversion, the enrichment, and the fabrication phases of the nuclear fuel cycle. And plus, Westinghouse is on the cusp of an absolute renaissance in its energy systems division, which is considerable step change in cash flow and earnings, all meaning that earnings potential and the cash flow potential of Cameco, strategically positioned and patiently positioned in this cycle, has never been better.
With that, we're going to talk a little bit more about some of these brownfield assets and the ability to leverage those first, and of course the C&M assets as well that you guys are holding back as you guys continue to negotiate out and work your contract book here in the future as prices become a reality here for you guys as far as where you want to place those contracts, at what price and what terms. Any other comments there before we move on? I want to talk vertical integration in just a moment, but any comments as far as your guys' cash position, any comments there as far as the cap structure before we move on?
Yeah, I mean, we're right where we want to be. We're $1 billion Canadian of long-term debt, $750 million of cash on the balance sheet, an undrawn revolver of $1 billion with an accordion feature. We've got an incredibly strong liquidity position as our contract portfolio, you know, has the upside of the stronger pricing we've seen in the last couple of years, hasn't even fully run through our revenue line yet. So that stronger pricing is still in front of us. That stronger performance is still in front of us while we're in an incredibly strong financial position. It is good times for Cameco.
With Cameco's vertical integration work that has been ongoing really over the years, what can you tell us in terms of objectives on the proportion of revenue mix in the future when it comes to mining and milling, of course, refinement, conversion, enrichment segments, fabrication segments, as well as the reactor build segment, of course, some of that coming from your guys' ownership in Westinghouse. Just talk a little bit about that.
Yeah, it's an important part of our strategy, and it's not new. When Cameco was born, it was the combination of exploration, mining, and milling assets with downstream fuel service assets that were positioned mostly for the pressurized heavy water reactor market, the CANDU market, the 8% of the world that's CANDU reactors, with the exception, of course, of the Port Hope conversion facility that does have the Western world's largest conversion capacity to UF6. And of course, Canada did not require UF6 because there was no enrichment required in Canada until recently, when Ontario Power Generation decided to begin to build the GE BWRX 300 reactors, which are conventional light water reactor technology and will require enrichment. So we've always had a set of assets that are vertically integrated and allow us to sell not just the product, uranium, for which there's no substitute, but also the key services that all bundle together to offer the fabricated fuel solution, as well as reactor solutions to utilities. Because that is our heritage, acquiring 49% of Westinghouse absolutely makes sense and is completely consistent with this, because now together, between what Cameco does for fabrication in pressurized heavy water reactors and what Westinghouse does for fabrication and reactor services in light water reactors, it's well over 60% of the global reactor fleet that has our fuel loaded in it. And then that, of course, gets us into conversations with folks about the rest of the services and the product of uranium that goes into it, because investors need to understand in the nuclear fuel cycle, fuel buyers buy backwards. They don't start with the uranium, buy a bunch of uranium and then put together the suite of, in the case of light water reactors, conversion, enrichment, and fabrication. They go the other way. They look at their reactor, they look at the fuel needs. Their first phone call is to the fabricator, the person that they've contracted to fabricate their fuel, to determine how much fabrication capacity they have under contract and whether they need more, and they will contract for more fabrication. Then they will call the enricher and will contract for more enrichment service. And then, in the light water reactor case, they'll go and they'll look for the conversion service. And only when they've lined up those downstream services will they really meaningfully go to look for the uranium, because now they know where to have it sent. And this is important because really there are only a handful of mission critical, too big to fail Western conversion, enrichment, fabrication facilities that you can send your material to. And we happen to have an important position in a lot of them as Cameco. So we are in a really unique position to be engaged downstream with utilities long before a uranium-only producer ever has a conversation with that utility. So being a part of that fuel cycle drives a lot of value, not just for our customers, but also for our investors.
It's definitely become pretty close to a one-stop shop. I mean, maybe you could talk a little bit about maybe the final back end kind of retirement, recycling, storage, et cetera. But generally, this is almost a one-stop shop now, especially a big step in that direction with the Westinghouse transaction that occurred. So very good information on that, Grant. Appreciate you discussing that and how important that revenue mix is for the company. It certainly is heavily effective during these various cycles within the industry. It's worked out quite well.
Yeah, when you talk about sort of the targets, if we look at the uranium through conversion, through enrichment, fabrication, and of course the reactor division of building new reactors, that one-stop shop idea has really been part of our strategy. We operate the world's two largest uranium mines. We operate the world's largest uranium mill. We own and operate the world's largest uranium refinery, where all the uranium destined for conversion and enrichment in North America goes through, and that's in Blind River, Ontario. We have the Western world's largest conversion capacity in Port Hope, Ontario. I already mentioned that we fabricate, between us and Westinghouse, well over 60% of all the fuel bundles that go into reactors. And then, of course, the AP1000 gigawatt scale reactor is becoming the dominant technology in those markets that are looking for additionality of nuclear. The one piece that I skipped over is enrichment. We're not yet commercially in the enrichment game. I have every confidence that Cameco will be in enrichment. Exactly how we get in is still an open question. Obviously, we've been spending a lot of time developing third generation laser enrichment technology, but that's not the only opportunity in enrichment. We'll continue to work on that technology and continue to try to build a pathway into the commercial enrichment market. But we will be in the enrichment market at some point. And at that point, Andrew, we have not only the best exploration land positions, we have the best gigawatt scale reactor, and everything in between. When you think about how we target those different divisions for their economic performance, it's absolutely dependent on where the market is at. If the market is busy wanting to build new reactors, well, there'll be a lag before when that comes through the fuel cycle. So then we'll target stronger performance in energy systems in Westinghouse and then capture that demand build as it goes back into fuel. In the last couple of years, the market's been really concerned about replacing Russian supply, which is what's put a lot of pressure on the conversion price and led to this historic conversion pricing right now. So we've been spending a lot of time on the forward contracting of conversion. So we will just react to where demand is coming into the market. It goes back to the point I made earlier. A fuel cycle participant has never maximized their value to their owners by front-running demand with supply and producing or building productive capacity that didn't already have a home. We don't intend to do that. We intend to maximize value across this transition as it builds out.
Absolutely. And you guys have all the parts and pieces now to capture more enrichment there. Obviously, you guys have GLE, a stake there, already in there to some extent. And then, of course, with Westinghouse, that'll also come in here as you guys continue to evaluate that strategy now, looking down into the fuel cycle and capturing that last little bit. And there seems to be a lot of hot air out there, Grant, right now with respect to potential projects and projects that are supposed to be built and, time frames of 10 years from now, et cetera. We'll see what happens. Definitely, it's an interesting area to get into as we continue down through this cycle.
I take it as actually proof that things must be good in the nuclear fuel cycle when we have uranium companies that are pre-discovery, that haven't discovered anything yet, but they're already calling themselves uranium companies. When we have companies calling themselves conversion companies and they don't have conversion technology, or companies calling themselves enrichment companies and they don't have enrichment technology. Things must be good when we're at that part of the cycle, when people without technology or without a resource base are clearly labeling themselves and positioning themselves for investor interest. We've seen this before. It does not change our focus, our relentless focus on being strategically patient and capturing the value of the demand when it comes and not front running it.
Some junior marketing in play there for sure, Grant, on some of this. Appreciate the comments on that. I want to move to some of the tier one assets for a moment on the uranium mining side. And of course, the runway ahead of them left with, of course, depletion. These projects have been running for many, many years. Of course, there were some care and maintenance periods, but depletion obviously is always continuing to happen when you're in the mining business. McArthur River has runway left in it to the 2040 decade. Cigar Lake, on the other hand, shows a production profile, license landing somewhere around 2031, roughly about 5 years out, which in a mining sense, it's fairly short time frame. And of course, considering the jurisdiction, talk about what you see replaces Cigar Lake should it wind down. I mean, that is a substantial asset, hard to replace. And if it does wind down in the early 30s, or if you see some extension to mining at Cigar through deposit expansion, we know you guys have the capability, Grant, of selling lots of pounds forward. Certainly that can happen. But just talk a little bit about how you guys look at that replacement, because yes, you do have other assets, brownfield assets. If you cobble a few together, certainly you can replace it. But just talk a little bit about the thinking on that front.
I would say that one of the things that is absolutely crystal clear is today's uranium price, which is now the long-term price in the mid-80s US dollars. It's a very good spot to be in, is not sufficient. because it's not reflecting what you just said. Cigar Lake and Cigar Lake Extensions project takes Cigar Lake out till about 2036, and then Cigar Lake is done. There's an 18 million pound hole in the primary supply stack at that point. About 10 years later, if nothing changes, McArthur River also depletes out. So now you're talking about a 40 million pound hole in the global primary supply stack. Today's prices don't reflect that challenge that's coming. But ours is a market that we have to strategically wait for those who need the uranium to realize the scarcity value. And when they realize the scarcity value, they will be willing to pay the production economic prices that are required to develop the replacements for Cigar Lake and McArthur River. If we announce today that we're going to do that, it will take pressure off the demand side of the market. Folks will say, oh, well, Cameco, we knew you had a volume strategy and you were going to go ahead and replace no matter what. We don't have a volume strategy. We have a value strategy. And we've played this value strategy out in conversion. We had to take our Port Hope conversion facility down under 6,000 tons per year of production before the market realized it needed to pay a lot more for conversion. We're now at historic conversion pricing and now on our way to run our conversion plant at its licensed limit of 12,500. We're working towards that production level. This market apparently needs proof that there's scarcity before it's willing to pay for it, even though it's pretty clear when you just do the analysis you just did. That means we have to be strategically patient. It is why we are not out there hyper promoting new projects. It's why we're not out there hyper promoting where growth is going to come from, because then the fuel buyers hear it and it helps them, it helps assure them that pounds are going to be there in the future. What this market needs to see is the realization there's going to be a shortage. So when you look at Cigar Lake, we've already made the decision to extend Cigar Lake out into the mid-2030s, 2036. That work is underway right now. If you think about Cigar Lake, I talked about it as an 18 million pound hole in the primary supply stack globally, but it's only a little over 9 million pounds for Cameco, right? We own just over 50% of Cigar Lake. So our challenge is just to replace 9 million pounds, not 18. I mean, we don't have a responsibility to replace the Orano share or the Japanese share. That's not Cameco's problem. So if you look at it through Cameco's eyes and you reflect on what I said earlier, that 30% of our tier 1 and tier 2 production is currently either in discipline or care and maintenance, we've got enough brownfield leverage as Cameco to replace our share of Cigar Lake. We could produce more from McArthur River. Of course, that will bring its depletion forward. We, together with the Kazakhs, could produce more from JV Inkai if the market was really signaling it. We could bring back our Rabbit Lake mine. We could bring back our US mines. So the problem for us is something that is very manageable. We have the resource base and we have the brownfield leverage already. So this for us is just about being strategically patient and seeing that kind of reset that happened in conversion, seeing it happen in uranium, and realize that we have a role to play in that we have to be disciplined. So I'm not worried about how Cameco replaces our share of Cigar Lake. I don't know where the other half comes from, and that will be a hole in the market that needs to be reflected in higher prices. But ours is not a game of front-running demand with supply.
And you guys do have that ability through your development projects, even if you have to go beyond US and Canada, you guys certainly have that capability to do it on a full level if you wanted to, Grant. I certainly see that there when looking at the various projects and assets that you guys do hold. I think the strategy is sound, though. To leave it makes a lot more sense for now. You guys will put forth the capital and do the work with respect to expansions, and that is just simply replacement of depletion. And that can be done to some extent as well when you guys so choose to do so. And then I think with that, I think one other layer of compounding problem comes in where while Cameco is probably the best at this out there in the industry, speaking of specifically uranium mining, you guys have been able to meet your promises better than anybody else out there. But these are tough projects. All of them are tough projects. And of course, we saw that with McArthur River restart, that, hey, it is very hard. And even the best out there can have small challenges. So when you layer on the risk of potentially things not coming online as planned, cake in a can not coming out in the volumes needed, it can add pressure to the market. So I guess in that sense, that could be a good thing. And so I appreciate your comments on how you guys are looking at this and how you're going to carefully approach looking at dusting off essentially your guys' pipeline portfolio. You mentioned Inkai. Talk just a little bit about that joint venture operations in Kazakhstan. Any comments on that asset, Grant, and its, of course, its reliability in the near term, maybe from a geopolitical standpoint, including maybe just again that you guys potentially would have the ability to replace that asset in the future as well.
I'm going to talk about JV Inkai, but I do want to put a finer point on, I think this goes together. I do want to put a finer point on what you said about the market relying on promises of future production. You know, I've said a number of times that this market often conflates, and I mean the demand side of the market, it often conflates a preliminary economic assessment with a pre-feasibility study, with a definitive feasibility study, and with a technical report. And anybody who's spent even but a moment in the mining industry knows that you've got a massive gap between a preliminary economic assessment and a technical report. In fact, a technical report is done under very strict criteria on an already existing asset. There is no comparison. A definitive feasibility study is no comparison to a technical report. And what we do know is that preliminary economic assessment, the PFS and the DFS, well, these are just promotional documents. These are not true plans on how to truly build a mine and a mill. You know, I think we can stack them all up and say they're hyper promotional. And the reality is going to be many of these projects, if they get their license, are going to find themselves 50% through their budget and 10% through their schedule. And then investors are going to realize that that definitive feasibility study was not a reliable predictor of the project. And at that point, you're going to see much, much different valuations. You're going to see those with existing assets be valued much more strongly than those who started a project on a promise. And that's a great opportunity for the market. When people say, why are you disciplined right now when everything's looking so good? Why aren't you fully on the gas with expanding and with bringing in new mines? It's because then you just contribute to that sentiment that there's going to be more supply. And that sentiment is what keeps demand out of the market. And then therefore, you're not seeing the strong enough pricing. So when the market realizes that it was counting on stuff that was unreliable, and it was counting on teams that were unreliable, the price of uranium is going to go up. Because at the end of the day, a tier one producer is proven, not simply promised or press released or promoted. And at the end of the day, a tier one asset is demonstrated. It's not simply discovered and declared to be tier one. It's only tier one when you're actually producing from it and can prove that it's tier one economically. But in our market of long-term forward contracting, it takes time for the demand side to realize this. We've seen it before. We've been in every commercial cycle. And just like in conversion, if you wait and are strategically patient, the value will accrue to true tier one producers and true tier one assets. But you do have to weather the noise of hyper promotion. And that's kind of where we are right now in the uranium space. So JV Inkai is a bona fide tier one producer, Kazatomprom, over 40% of the world's uranium right now is coming from assets that Kazatomprom runs, bona fide tier one producer. They are proven. And JV Inkai is one of the world's crown jewels. It is an absolute tier one asset demonstrated and proven to be one of the best uranium mines on the planet. We continue to have a great partnership with Kazatomprom. We continue to be aligned with them commercially. They understand that the days of having a whole bunch of supply with no home are over, that was value destructive for the nation of Kazakhstan. It was value destructive for the value of their uranium resource. They now know they have to have a strategy like ours. They have to build the contract homes. And as those contract homes are building, they have to be in a very disciplined position. And we're aligned with that. When I talked earlier about the potential to increase JV Inkai, remember I was doing it in the scenario where the world finally realizes there's a hole coming with Cigar Lake and a hole coming with McArthur River. And Andrew, that might seem like a long way away, middle of next decade and middle of the 2040s. But if you're building a gigawatt scale reactor today, that thing's going to run for 100 years. So these aren't very far out, but the world needs to realize this hole is coming, price it accordingly. And what I meant is when those prices are realized in a long-term contract portfolio by both us and Kazatomprom, we're probably going to be in a conversation about mutually wanting more production out of JVI. But at the moment, we're both in a very disciplined position because we're waiting for that demand to form. In the meantime, it allows Kazatomprom to work through some of the challenges it's had. Disentangling its uranium supply from Russia in a world of sanctions, the challenges it's had with acid supplies, drill rigs and piping and casing. And they're going to work through all of that. And right now, it's great timing because they are in a strategically patient stance, just like we are anyway. So it affords them, just like it affords us, the time to plan the production right.
Few things there, Grant. I think it makes sense. Well, first, congratulations just on your ability, Cameco's ability to work with Kazatomprom, work through some of the geopolitical issues, some of them quite silly, but the fact is you guys are being able to work through that and actually bridge a relationship across some of those places where sanctions may apply or people are irritated. So many factors to this. So I appreciate you guys being able to work with your clients and with your partners across the board. So that's first a great thing to do. And then working also together to, make sure things in the market are moving along in the direction that they should, given the outlook, I think is also very important. And so good work on that front. Back to a couple things you said before that. When it comes to a bankable feasibility study or definitive, whatever you want to call it there, towards the higher end of the certainty, I think it really just boils down to generally that who is behind those documents? What is their credibility? And as you know, most of these are just marketing documents from ABC Junior Co., who's never done anything in their life, let alone build a mine, let alone put cake in a can, aside from all the other technicalities. So very much agreed on that front that it doesn't mean much in most cases. There's no doubt about that. So, and I think we'll see a little bit more of that in terms of, I hate to use the word failures, but that is what it is. There's going to be more attempts in the coming years. The tide goes out and we see who gets to swim naked, I suppose, in the sense that at some point the storytelling's got to come to an end and you're going to have to do something, or investors, the market will start to realize what you are. And so I think that's the other point to make too, that you started into a little bit there. Why don't we shift over? And of course, I'll take comments in a moment, but let's add to this question. I just want to have you talk what you can say here. I know this is getting into strategy, but the suspended C&M operations, also the development projects coming to mind. Of course, that could be something that comes in late decade, maybe in the 30s, some of this stuff, but you guys do have projects that span, of course, we can include Kazakhstan here with the partnership, but also there's development projects and things to be had in Canada. There's things in Australia to be had. There's things in the United States to be had. Just talk about what you think would be the low-hanging fruit to start out, because you did say that, you guys have projects that don't necessarily need a new mill. You got projects that can be hauled and brought in to existing infrastructure. We see the Cigar expansion being planned potentially. Talk about that low-hanging fruit pipeline, I suppose.
On the uranium side, we have an incredible position, or I would say set of optionality. I don't think anybody has the kind of optionality that we have. Our strategy, as I've said and will say over and over again, we wait for that demand to come to the market. We capture that demand in terms and conditions that make sense for our owners. When we capture that demand, remember, deliveries don't start right then and there. Deliveries typically under a long-term contract begin at least 2 years out, sometimes even longer. So Andrew, it always gives us that runway to then prepare our production profile based upon the demand that we've captured. We're never trying to respond to a spiking spot price, and being really undisciplined in trying to jam more production into a spiking spot price. We actually step back from that, capture that higher pricing into long-term multi-year contracts, and then afford ourselves the time to allocate the capital and the resources to get production from where it makes most sense. And obviously, going to our tier ones is the first stop. So if you think about that rank order, well, one of the decisions we've already made, the extending of Cigar Lake out into 2036. So that decision's already been made. That was the first, place to go in our tier one assets. The second, we're doing a bunch of work right now to understand the optimization and efficiency of taking the McArthur River mine and the Key Lake mine to a higher level of production. They are licensed to produce 25 million pounds a year. In 2025, we've got guidance 14 to 15 million pounds from McArthur River Key Lake. That's it. But we're doing the work to understand what's required so that if we pull the trigger and we have that 2 to 3 years runway, what do we need to do to get to 25 million pounds? That's an extraordinary amount of brownfield leverage from what has been the world's greatest mine and mill infrastructure. Then I talked about Inkai already. That's a tier one asset that if the conditions are right for us, they're probably right for Kazatomprom to take that asset 20% above its subsoil license amount, which it's allowed to do under Kazakh law. So just right there in the tier one space, we've got an extraordinary amount of leverage. Then we've got, as you mentioned, the Rabbit Lake mine and mill in northern Saskatchewan. When we took Rabbit Lake down, it was producing at about 2.5 million pounds. It can produce up to 5. It has a mill that's licensed for up to 12. Rabbit Lake's got a lot of life left in it. I mean, the only problem with Rabbit Lake is its neighbors are Cigar and McArthur. If you look at Rabbit Lake in a global supply stack, it's one of the world's best uranium mines and milling infrastructure. It just happens to live next door to the absolute crown jewels in the uranium space of McArthur and Cigar. But Rabbit Lake is still, we've kept it in care and maintenance because Rabbit Lake is incredible brownfield optionality for us. Our mines in the United States, Wyoming and Nebraska. In Wyoming, we have the largest milling capacity. So if we find ourselves in a world where there is really going to be a premium for US origin, which by the way isn't today. So for those who are telling investors that there's a premium for US origin, it's not true. But if there was, we have the standby capacity that is the largest in the United States. So again, it's about being strategically patient. And then that affords us the ability to bring back tier two assets into a market that's discovering higher prices because demand is coming. After that, the next place we would look is both in the mining portfolio, but in the technology portfolio. Remember, our global laser enrichment project, our commitment to the Department of Energy is to re-enrich depleted UF6 tails. So we take depleted UF6 tails that are at Portsmouth or Paducah that the DOE, it's a liability management program for the DOE. You re-enrich that back to natural UF6 and you have yourself a facility. It's a manufacturing facility, but it's actually a 4 to 5 million pound uranium mine and a 2,000 ton conversion plant in disguise. So we have that optionality within the time frame that you would be building out to meet new long-term demand. Plus, when we look at the mining portfolio, we would always choose to leverage brownfield. You know, if we If we're bringing on a new mine, we would want to do that in a jurisdiction where there's already existing mills and there's existing roads and there's existing power and there's infrastructure for employees and contractors and all of that. So that is always a better investment than a greenfield mine and a greenfield mill. And I would just say on that final point with respect to the mill, I often hear folks, new entrants to the space, casually talk about a uranium mill as though it's comparable to a mill that you would see in a base metal operation. And the only people who will say that is people who have never stepped foot in a uranium mill before. It is a very unique asset. It's a Class 7 facility with radiation protection and all of the challenges that go along with it. And it actually is more of the critical path item than the mining infrastructure. So investors always have to ask themselves as they see companies parceling together all these mining options, your first question should be, what's your milling strategy? Because the mined product has no commercial opportunity until it goes through a mill and is an ASTM spec drum of yellow cake. And often that piece is forgotten. So that milling infrastructure is going to be the next critical path item, like the conversion plants are today. That's the role milling will play in the future. We happen to have two mills in our portfolio, Key Lake and Rabbit Lake in Canada. And we've got the Smith Ranch and Highland Mill in the United States. We've got a smaller mill in Nebraska. We're in an incredible position when the world realizes that milling infrastructure is critical path. So once we step through all of that optionality, Andrew, then we're talking about true greenfield mine, greenfield mill, maybe looking at options in Western Australia, for example. We've got a great deposit in that Yeelirrie deposit, but it's for later in the supply stack. All of that to say, we've got lots of options, we've got lots of growth, but none of that occurs until the market is signaling it's prepared to pay for that. And that's why we remain disciplined.
Appreciate the thoughts on this and how you guys are looking at that sequencing. Well, I'm looking for a site for you guys to procure that fleet of scrapers for Yeelirrie. That'll be fun. A great pipeline here and a lot of optionality for you guys. Well, one other comment before we go here on the next question. When it comes to milling capacity, Canada is a great example. You guys have substantial mill capacity there. Some of it's unfilled, of course. From a jurisdictional review standpoint, when regulators look at new milling capacity, that's going to be an interesting one in the future to keep an eye on as well. So you guys, of course, are positioned very well here. I'm going to lump two questions in here. First, it really has to do with Cameco uranium mining segment and milling segment production independence in the future. Because when we weigh this now and we look ahead, based on expectations that are pretty certain at this point, as well as frosting on the cake, if you will, just considering that 100% in-house production to meet the needs of other company segments, and then of course, term contract fulfillment. I want to just have you talk about that in-house production to meet the needs there. And then also, let me just lump this in just for sake of time. There remain to be the non-material exploration efforts so far, spending a few bucks, about 15 million on various exploration activities in 2024 from what I could compile here, but not a material focus. But when it comes to obtaining pounds for the needs of the fuel segments, the commercial power station services of Cameco through with the Westinghouse stake, and of course, term fulfillment, where are you seeing the opportunity to gain more pounds on, say, the less expensive side? Is that in secondary supply pounds, exploration pounds, buying finished pounds from various market opportunities, or perhaps M&A pounds from companies that just aren't able to successfully produce those pounds themselves?
Andrew, you just asked me two questions that I could take 3 hours on. There is so much to unpack there. So let me make a couple of points and then remind me if I'm not covering everything, that all the dimensions that you asked about. Let me start with our exploration portfolio and our exploration spend. And let me just put it in that context that I just described with respect to our future optionality. We sit on 1 billion pounds of reserves and resources. And I know I'm not supposed to add those two things together, but I just did, sorry. And we have a very, very low harvest rate. We harvest less than 5%. In fact, we harvest 3% of our existing portfolio of resources we already own and we already know, and they're already on our balance sheet. We're not harvesting 10% of our known resource base or 20%. We're harvesting way less than that. And that's what drives our exploration spend. And right now, our exploration spend is really focused on continuing to leverage brownfield, because in the uranium space, those are the best investment dollars to spend. They're superior investment dollars, superior investment returns to the greenfield investments that are being made. So it's not that we don't care about exploration, it's just we have such a significant endowment of pounds that already leverage existing brownfield. We just don't have a need to drill for more resources that are 10, 15, 20 years out in a production profile, because you can even give me a really, really low discount rate and they're not worth a lot today. So it's not that we're not interested in exploration, it's that we're still enjoying the benefits of very, very successful exploration packages from the past. You did ask about jurisdictions. We continue to be focused on where we have infrastructure. We're focused on the US, we're focused on JV Inkai in Kazakhstan. We're really focused on the Athabasca Basin. And the east side of the Athabasca Basin, we've got a position on the west side, but there's absolutely no infrastructure on the west side. There's no power infrastructure. The roads aren't sufficient for a massive construction project. The airport infrastructure isn't sufficient. There isn't housing for employees and contractors. Like the western side of the Athabasca Basin is deficient in the core infrastructure that's needed to start the kind of industrial activity that you would want to see required for a mine and a mill. So our focus is where there is infrastructure on the east side of the basin. And it's a bit of a cliche in the exploration world, but if you want to go hunting for elephants, go to where the elephants are. And that's where we found the MacArthurs and the Cigars. And I say we collectively because Cameco just didn't find those ones ourselves. And we still think there's a lot more prospectivity. It's why we have such a huge land position on the east side of the basin. So exploration is right-sized for where we are with our endowment, where we are in this cycle, and where we are with respect to our brownfield leverage opportunities. So then you asked about where we source our material. Obviously, we like to get a bunch of material for production. And you see that we also like to purchase material. And let's just strategically talk about why we do this. We do this because of a bit of silly behavior we see in our market. The uranium market has no meaningful spot market, right? The run rate requirements of utilities are bought forward under long-term demand. And yes, utilities buy a little bit in the spot market, but if you look out over the last decade and a half, utilities have collectively only bought about 10 million pounds per year in the spot market. That's it. And what they're buying is very discretionary volumes. They're not buying their run rate requirements needed to run a reactor 12 months from now. They're buying if they're shoring up an inventory position, or if they have a reload coming up and they need an additional volumes kind of 2 to 3 years out. That's what they're doing in the spot market. And so you need to remember it's super discretionary. They don't have to buy that day, that month. They don't even have to buy that year. Even though it's end user demand, it's very discretionary. The rest of the spot market is just churn. And where does that churn come from? Well, unfortunately, in our market, there are those on the supply side who either do not know any better, and they just haven't paid any attention to how the market works. They make material available in the spot market. They sell it to a trader or an intermediary, or they sell it directly to a utility who has discretionary demand. That puts downward pressure on the spot price. Or like I said, they sell it to a trader or an intermediary who is then going to churn it around the market 3 or 4 times. So we end up with a market, that looks like 50, 60 million pounds has transacted through it. 10 of it is end user demand, and the rest of it is the same pounds going around 4 or 5 times and looking like 4 or 5 times the volume, but it's just the same pounds, trading hands on a Friday and on a Monday as traders and intermediaries play games with the spot pricing. Because we know that that occurs, Andrew, and we know that that has an effect on forward expectations of floors and ceilings and the long-term price on a go-forward basis, we always reserve some demand to deploy into the spot market when we see this kind of silly behavior happening. But what we will never do is underwrite the silliness. Cameco will not sign on a long-term offtake with a producer who went and built an asset and had no home for their production. We're not changing the diapers on all the infants in the industry. But what we will do is buy that material after they're punished by dumping it into the spot market and pushing the price down, and therefore not meeting their own investor expectations. Then we might go buy it in the market. But we don't, it's not the job of our owners to clean up the mess made by those who don't know what they're doing. So we do not target buying from intermediaries who have an offtake from a producer who just simply doesn't know what they're doing, nor do we target an offtake with a producer who doesn't know what they're doing. They're going to do damage to the market. When they do damage to the market, we will wait till that material hits and has a negative effect, then we'll buy it. And then when the price goes back up, that margin is for our owners. It's not there to, we don't use our balance sheet to be the buyer of last resort. It disguises the bad strategy that some seem to have.
Well said, Grant. Thank you for going through that and highlighting, of course, the opportunistic events that can occur in the spot market, the constant churn and fun and games that happens in the spot market that occurs as well, and highlighting that. That's definitely been seen so many years here that I've been around in the sector. With that, too, I think that when you look at, there's not a lot of great assets out there. This market's been undercapitalized from respective exploration during the bear market. There's an occasional couple good assets that you and I might agree on that would say, yeah, could it be a tier one? There's not much out there, but there are maybe a few things out there without getting into too many details and names. But suffice to say, some of those pounds have some more value to them from a replacement standpoint. So what I'm getting here is there's a lot of opportunities for Cameco to go out to all these different faucets of potential pounds, different price levels, different timing levels. But you guys very much so compared to even a few short 4 or 5 years ago, you guys now have a serious firepower in the sense that you guys are so much bigger today because of very good moves, including the Westinghouse stake, among other things, here in the past. When the opportunity presents itself based on the strategy execution to go out and scoop up basically less expensive pounds because of the failures of others or the challenges that others aren't able to overcome, that Cameco is able to overcome, make a lot of sense here. With that, somewhat related, just shifting gears briefly here into secondary supply sources and risks. Anything on your radar, Grant, that you want to mention to the audience that is pertinent to bring up as this cycle continues and some of the problems within the market begin to get partially solved in the years ahead? Any comments there on impactful secondary supply on the horizon, probably from a view of a telescope or at least some binoculars, but further out, and what those sources might be?
Yeah, lots of comments on that. I am going to circle back to what I think was an M&A comment that you were making. I want to say that there are mining legends, and one of them is Pierre Lassonde. He described once something that has now become colloquially known as the Lassonde curve. And that's the notion that a mining asset is sort of at a high valuation when it's at the top of its promise peak. Good results, a good resource has been discovered, a PFS and a DFS have been constructed. There tends to be a relatively high valuation ascribed to those pounds in the ground. And then you jump years ahead and there's a much higher valuation on that asset when it's cash flow and earning. But in between those two high points is a long valley of development where somebody tries to convert a DFS into an actual mine and an actual mill. And they begin this journey through the valley of development. Some call it the valley of death. And they find themselves in the situation I described earlier, where they're 50% through their budget and 10% through their schedule. And investors and boards are going, oh my goodness, what have we done here? We have seen this time and time again in all of Cameco's time in the uranium cycle. Commercially, we have seen this occur. So we know that the new projects are going to go through the valley of development. And when they do, the valuations are going to reflect the reality of those projects. And for us, that is a much better time to be thinking about our position in assets that aren't in our portfolio than it is when they're either at the top of the promise curve, or certainly when they're cash flow and earnings, although that's a real tangible asset. But what we've seen time and time again is projects get themselves into the valley of development. They realize you can't build a mine and a mill for the prices and on the schedule that they've been hyper promoted on. And history tells us that's when our phone rings. That's when a group of investors or a board says, we've made a horrific mistake and we tried to do something, and it's now time to bring in someone who actually knows what they're doing. And those are the much better opportunities for us to enter projects, to come in, and spend 100% of the capital to recover a project until such a time as we own 3/4 of the project with the commitment that we market 100% of the output, for example. Those models will happen in the uranium space. So nobody should ever imagine that because Cameco's not buying stuff at the top of the promise curve, it's because we're asleep at the switch or don't know about other projects that are out there. I would immodestly say we know more about all of the other projects than anyone else does. But we also know that they are not going to be delivered under the value construct of a definitive feasibility study. And there will be better opportunities for us to be involved. Again, it's why we have to be strategically patient. So that's the backdrop for the M&A. Those projects have to compete with stuff already in our portfolio, already leveraged to brownfield. And so far, obviously, nothing's been competitive with the valuations we can see of leveraging brownfield. The secondary supply question is a great one, Andrew. And in fact, let's just put a really fine point on this. Perhaps the most misunderstood part of the upside for uranium is that this market no longer has the secondary shock absorber that it's had in the past. When I was describing the 06-07 price, $136 a pound back then, which is $200 a pound today, obviously we're not even close to that, there was still over 200 million pounds of material tied up in the megatons to megawatts deal, where Russian material was coming into the Western fuel market. There was a massive shock absorber when the Cigar Lake mine development project flooded, and yet we still saw $200 uranium in today's prices. You look around today, there are no big secondary mobile inventories. The US government DOE doesn't have one anymore. The Russian inventory, the 500 metric tons of HEU that was the basis for the HEU agreement, is gone. There just aren't those pockets of secondary supply. That shock absorber is gone. Now, some people say, well, no, there's the Yellowcake Fund and there's the SPUT Fund. Well, I actually view those as completely different. In a world where the uranium price is reflecting the scarcity and the depletion of primary production and the reality of the lack of secondary shock absorbers, actually the incentive for the Yellowcake investors and the SPUT investors is not to sell. It's to hang on and get an even greater capital gain than they're getting right now. So I actually see the incentive structure completely aligned with being even more disciplined with those financial holds than we saw with the DOE inventory material, for example, or the Russian material. So you can look at the primary stack and you can look at the realities of more primary production, but do not forget to spend some time looking at the absolute lack of secondary supply, the absolute lack of shock absorber material. That is the single biggest change from previous uranium cycles. And it's what probably makes us the most bullish about the recovery of the demand cycle in the uranium space.
Grant, thank you for walking through that. Back to M&A just briefly. We know that if there is an opportunity on that front for Cameco, that probably one of the first things that will occur, besides the dismissal of some of the staff on the target, would also be the tossing of the documents, probably right in the trash can, or at least a complete renovation of those documents from a standpoint of what is actually feasible in that DFS or BFS. With respect to secondary supply, when you add up those numbers, and there's different motivations and incentives there, certainly it's a bit of a sequestering vehicle when you look at those two different funds there that you mentioned. Some of them a little bit different in structure, a little bit different in incentivization, but generally these are also fee-based structures as well. They are set up to collect fees, and that the motivation there is for a ongoing, multi-decade fund that collects fees. And so that's part of the incentivization as well. And then when you add up the numbers, Grant, the total pounds, and you compare it to some of the secondary supply sources that you mentioned, it's really a drop in the pond, very, very small amount compared to past secondary supply sources. Definitely we'll be keeping an eye on that front as we go through now this bull cycle versus bear cycle, and keeping an idea on how things are going on that front. So I appreciate the comments there. I want to shift over here, just kind of wrapping up here, Grant. Thank you for the extra time today. We've seen a number of narratives fill this market over the years, going back to the early bear market days. Government involvement, subsidization, incentivization, state sponsored on various fronts, what have you, whether it be policy or direct investment. Questionable terms have come up throughout this period of, green, clean, carbon free being slapped on some forms of energy, including nuclear. We're pro carbon over here at this desk, by the way. But then also things like small modular reactors, and then now their derivatives have come up, return to the good old off the shelf, conventional yet proven large reactors. We're seeing private energy supply going mainstream, and things like data centers and artificial intelligence likely having some impact on nuclear energy as the leader. Subsequently, of course, impacting the fuel cycle. Of course, any more that you have that I didn't mention here. But which ones do you think will stick well to this market going forward and support this market in a serious material way in the years ahead?
The nuclear sector in general has really been attached to an investor sentiment around the data build out. And that's appropriate, because as the data build out gets bigger and bigger, the critical path item is electrons that are running 24 hours a day, that have capacity factors in the mid 90s of reliability. Like, all of the stuff nuclear is awesome at fits very well with this AI demand. But I said earlier that this is an accelerant to nuclear. It's not a core condition for a really bullish view on nuclear, because in behind the data AI is a general understanding in every market, you got to get the grid right. Over the years, folks have installed a lot of generation capacity that is intermittent, weather dependent, and unreliable for things like hospitals and education facilities and transportation networks and communication networks and industrial infrastructure. And there's just a return to energy security and getting the grid right. And that alone underpins a very robust outlook for nuclear. If you start adding gigawatts of demand because of data centers, well, that is just an accelerant on the growth case. But you don't need that to actually have an incredible growth case around nuclear, because of the desire to get the grid right. So bring back reactors that were shut down, extend the life of reactors that are operating, and then start to build new just to meet the reliability and energy security needs of the industrial infrastructure, plus all the stuff that needs electrons 24 hours a day. Then you add to that a bunch of electrification that we previously haven't used, transportation networks, industrial heating and process, residential heating, stuff that historically hasn't been electrified. That adds an enormous amount of demand to the grid. The data is just a leverage factor on that, but it's not required to have a strong growth case. And then when it comes to thinking about nuclear's role in those 24-hour dispatchable, hardened, durable electrons that are required to meet this energy security need, I have a bias here. And I simply say new nuclear power has 5 big risks. Number 1 is technology risk. Number 2 is fuel risk. Number 3 is first-time licensing risk. Number 4 is first-time regulatory risk. And number 5 is just good old-fashioned project risk that any project has. And I just have this position that if you have a technology that removes 4 of 5 risks from the calculation on day one, it's probably a superior technology. And that's where the AP1000 fits in. The AP1000 reactor has no technology risk. Its reference case is Vogtle Unit 4 in Georgia. Southern Companies has not only constructed and commissioned, but has optimized the Vogtle 4 unit at Georgia, and that is now the reference case for any additional AP1000s. So there is zero technology risk. Number 2, there's zero fuel risk. Westinghouse knows exactly how to build the fuel for an AP1000. A lot of the advanced reactor designs not only have technology risk, but nobody has any idea what the commercial fuel is going to look like, let alone cost. So I don't know why we would take technology and fuel risk on day one. AP1000's already licensed, so there's no licensing risk, and the reference case is there. AP1000's already been regulated and located in one of the most mature regulatory jurisdictions in the world. So there's really no regulatory risk. There would be site-specific risk in various jurisdictions, but we know how to handle that from a nuclear point of view. So then it just comes down to big project risk. And if you standardize, sequence, and simplify like other industries do, we can return to the heady days of the 60s and 70s when the Western world was building, 25 reactors at once in various countries like France and Sweden and Japan and the United States and Canada. So these are not insurmountable challenges, but I just have this really strong bias as electrons have become the critical path item. And as nuclear is being looked at as a solution, why not choose the technology that removes 4 of the 5 major risks on day one? That sounds like a really smart thing to do. And that is the rationale behind the agreement with the US government to commit $80 billion to kickstart AP1000 construction in the United States.
Well said. Sounds like the return of good old off-the-shelf, conventional yet proven large reactors, which is my favorite area of this whole thing. The rest of it, significantly questionable, whether it's the buzz terms, whether it's the new technologies, whether it's on the shelf or off the shelf, or now you need new licensing. There's a lot of silliness out there, the consolidation component of all the SMR technology, all the crap. This is the place to go, and you absolutely nailed it. And I think, yes, sure, it's biased, it's Westinghouse, sure. There's other good folks out there that are building some decent units.
I had somebody say to me one time, oh, you only like the AP1000 because you bought Westinghouse. And I'm like, well, you've got the correlation right, but you have the causation wrong. I bought Westinghouse because I love the AP1000. It is a great reactor, and it is the reactor that will dominate the Western build out of gigawatt scale nuclear because it's a Gen 3 plus reactor that's already proven. It's running at industry leading capacity factors and performance levels, and it's Western technology and a Western supply chain. It meets all of the energy security boxes. and has none of the technology, fuel, licensing, or regulatory risk that other reactors have.
Absolutely. And that period, the 60s through, basically the 80s, what a fantastic period of record-breaking builds, or record achieving. I mean, because we haven't been able to do that. I mean, maybe the Chinese will do that, achieve that in the future if they keep on their pathway. But the other thing here too, as you touched on it, is it viable for these classic off-the-shelf conventionals to be built in 4 to 5 years? Is that fair?
The U.S. Department of Energy put out a liftoff report on gigawatt scale new build that was published in October of 2024. And Julie Kozaraki, the director of the Loan Program Office, which I think has been renamed to the Office to Finance Energy Security or something like that. It's got a new name, but Julie Kozaraki is the director there. And she was the author of this liftoff report. And what they did was they took the experience from Vogtle 3 and 4, the industrial effects, the learning effects of going from, first of a kind on your path down to nth of a kind. They overlaid the experience in China. China is building the AP1000, their version of it, inside of 4 years, and for about $2.5 billion US a reactor, because they kept building. They just kept going with that reactor. You layer in the learning effects of the 4 units that Issac built in the United Arab Emirates along with the Koreans. And you kind of model out what that looks like for AP1000s if you stand up the supply chain with a big enough order book and just get going. And there is no reason why the West shouldn't be able to achieve new build from first construction to commissioning, inside of 60 months and inside of $5 billion US per reactor. The first 2 are not going to cost that because you're standing up a lot of the infrastructure. But part of the vision behind the $80 billion was get a big enough order book to really incent people to get serious about it, and let's get down the learning effects curve as fast as possible. So yeah, Andrew, it is completely reasonable to assume that the nth of a kind reactor is built inside of 5 years and well inside of $5 billion US a reactor.
Absolutely. Agreed with that. And we need to tack on and go after some of the knowledge that still exists there of some of the people who participated during that last revolution.
And for a reactor that's going to last 100 years, let's not forget about 5 billion or inside of 5 billion sounds like a lot. A 5-year build sounds like a long time. For something that's going to last and produce reliable, low cost energy for 100 years, seems like pretty easy math to do.
That's quality of energy right there. If I could put that into one term, quality of energy, absolutely. Just imagine a solar panel or a wind turbine getting that. Probably not going to happen in our lifetime, Grant, but anyway, let's shuffle aside the wind and solar debacles for another day. Look, good discussion here. I know we could keep talking for hours here, but just for the sake of time, we'll wrap it up here. 2 elevator pitches to close up here. First, why should utilities enter into fuel services contracts with Cameco?
Well, that one's easy. We are the most reliable supplier in the nuclear fuel cycle. Decades and decades of performance through thick and thin, delivering under our commitments. We sign a long-term contract with a customer and we honor that long-term contract with the customer. That is our commitment.
We certainly have seen defaults out there from other parties, although they'll try to sugarcoat that default. Second elevator pitch here for potential investors who are listening in. Cameco has a market capitalization of about 37 billion US dollars. Why should Cameco be considered within the institutional, family office, and retail investors' portfolio at this stage?
If you care about the grid and you believe that electrons are the critical path item to energy security and energy dominance, and you believe that nuclear plays a role in that, then look no further than Cameco. In Cameco, you have everything from the best exploration position in uranium all the way through to a position in the leading gigawatt scale reactor technology, and along the way, a suite of critical, strategic, too big to fail nuclear fuel cycle assets that benefit from brownfield leverage, that will not have competition pop up very quickly, highly regulated markets with high barriers to entry. we have put together the most strategic suite of Western fuel cycle and reactor capabilities. So if you want to play the nuclear space, there's no better way to do it.
And Grant, the best way for folks to contact the company for further information?
Absolutely, just through our investor relations portal on our website. Our VP of Investor Relations, Corey Koss, very responsive. We'll get back to you right away. We'd love to have a conversation. We'll always tell you what the world looks like through our eyes.
Grant, thanks again for the time. Keep up the work at Cameco and best of luck out there. Thank you.
Thanks for having some time for us today. Really appreciate it.